Today, folks, it is that time of the week where we're diving into the stocks that fascinate me around my $204,000 portfolio on my path to financial independence to perhaps one day retire early, which is a journey that you might be on as well. Consider subscribing as we do this and build these portfolios together. I have been very fortunate this week as the markets have been continuing to rally quite strong, especially on the US side of the border, with recently the accumulation of my Google shares continuing to hit an all-time high, finally heading into earnings. It's going to be very interesting next week. I've recently started buying Tesla stock this week. I think I'm getting it at a good price, but I'm presuming and I'm hoping that we're going to see this drop closer down to perhaps the 160, 150 mark, if not lower, depending on how the market continues to digest those recent earnings, which have been abysmal from an analyst standpoint. But from a technical and fundamental company standpoint, I think this is just a short-term hiccup, a buying opportunity into a long-term vision of true growth that's just underappreciated. SCHD, I'm not buying anymore. My Schwab US Dividend Equity ETF, as mentioned, it's part of my registered retirement savings plan. I'll show you it within the individual account shortly, but I am trying to scale away from it. I'm using it as more or less a hedge against an overvalued tech market. If we start seeing a pullback in tech, I still truly believe as we head into an interest rate cut cycle as well, the lower half of the market, the more dividend-oriented companies will start seeing excelled returns. And honestly, with the dividend income compounded, SHD might as well be sitting at an all-time high in tandem with the S&P 500 today. But as mentioned, no matter how many individual stocks I buy, I will always be accumulating VOO in contrast to it, trying to maintain about 50% ownership in my portfolio in the S&P at all times. But it'd be nice to see SCHD weight down to about 20 to 25% as I continue to accumulate individual positions. And we'll talk about that because I'm still looking at some of these Canadian stocks in the banks. We're currently receiving around $4,100 or about 2.25% in dividends, though dividends, as mentioned, are not going to be the core focus of this portfolio. As time goes on, the goal is to get that to about $500 a month by continuing to buy the S&P and looking at some of these Canadian stocks. As I balance my portfolio out this year, I really want to get this closer to around $6,000 in annual income, or that $500 a month mark. I think would be a sweet spot and would make me a little bit more satisfied. But we are definitely working hard at rebuilding this portfolio back, as again, you might recall after the real estate purchase last year, that dropped the portfolio down closer to, I think, what it was around between 150 and 180. And after a lot of work over the last 5 months or so, we've been really getting this back up and finally peaked that 200K mark with about 13,000 in cash still. And again, I'll always have the goal is about 5% weighted in cash. But as I collect income, I'm always continually trying to throw it in the market as much as possible. We're at over $20,000 in gains since the market recovery, and seeing how that looks in the individual accounts. My TFSA is where most of my focus is right now, because when I pulled out that deposit from this account, I had about $170,000 that I can now recontribute this year, and we've only got about 25,000 of that recontributed, or 24 after the gains. So we got a long ways to go to start building this back, but it is a very good chunk considering we've only just started the year. And again, this is where I'm getting most of the gains on my Google shares right now. I'm looking at more growth-oriented vectors for this portfolio, because once I kind of get to that financial independence point, which I'm hoping is going to be before around 40 is the guess, somewhere between 35 and 40, I want to be at that place where I have the option to semi-retire, where I'll be more dividend oriented in this account, but I'll be taking the gains off these growth vectors that I think have good potential in the next 5 to 10 years to definitely outperform the dividend companies, so I can have a much bigger pile to be generating cash flow off of. So that's why I'm really focused on US stocks like the S&P, companies that I think are trading at discounts. So I'm playing a little more speculatively in here, which isn't advised by any meanings, but I've had such good gains in here, and I saw Google at a good discount point. It's working to my favor. I think Tesla's getting there, and it'll be a stock I'll be accumulating over the next 6 months, and we'll see how that pans out, which you can subscribe for and definitely continue to see what I do with these accounts. Again, my registered retirement savings plan, SCHD, I know is not sitting at a technical capital gain all-time high, but we've had 2 years of a market where SCHD has been relatively flat, but we've been collecting really good dividends, and the dividends have actually been hitting all-time highs. So I'm very happy with this ETF, and I'm going to continue to cost average into it by reinvesting the dividends for now, because in this account, I don't get withholding tax. So I'm going to focus more or less my US dividend-oriented companies within this account, but primarily I'm getting all those dividend companies through SCHD, which we're seeing some great returns on. By all means, I mean, a 5% gain so far since I've been cost averaging, plus the couple years of dividends. And if we take a look at SCHD's stock, just to see what the stock performance is doing, we can see we're about 5% off the all-time high. But again, keep in mind that was over 2 years ago now, and we've been collecting over 3.5 points. So I mean, we're definitely past an all-time high just from the dividends, especially reinvested, collecting in these more discounted levels over the last year and a half. But that's just my opinion on SHD. I do love that ETF a heck of a lot. So I own some similar stocks where most of my holdings exist today, and I'm almost at parity because between my RSP and my TFSA, my regular accounts, I'm getting to about 95,000, I think. Whereas in my corporate account right now, I have about 110,000, and I'm trying to get that at parity. Most of my money sits currently within my corporate account, which I personally love because I think it comes with a more extended safety net. It kind of removes some of the liability. It's also better to equitably give these shares away if I pass on. And I love just having the diversity of protection in these investments between a multitude of accounts and different ways the government looks at it, from corporations to personal, which also gives better tax liabilities and other aspects as well. So this is a very fun thing to do once your portfolio is evolved and you have a side hustle. I think starting a corporation is fascinating, especially from the investment standpoint. But we can see I got a little bit of Google in here. I'm not going to be buying any more in here. I'm just holding these shares flat for now. Most of what I buy in here will be the S&P, but for now, I'm looking at pulling money out of the corporation. So all new money will likely go into my name to pay down the mortgage and continue to invest in my TFSA until those things get maxed. So I won't be buying a whole lot more within these accounts, but I'm not looking to sell any of this. I'm just going to put it on idle for now until I can, build up some of my personal accounts. So taking a look at the broader markets and talking about what I'm going to be doing kind of moving forward here with a little, anticipation. As I mentioned, Tesla, we'll talk about the Canadian banks, but we can see that the markets this week have been pretty exceptional yet again, which I think can be a bit of a concern heading into earnings season. I feel like we're pricing in a lot of what's about to come on the US side of the border, considering we're going to get Microsoft, which is very expensive. Google, that's now trading at almost a 30 PE or pretty much there, I think is priced in these earnings. So, I like buying these. I think when they pull back, we saw it with Apple pulled back and then immediately got bought. So, Apple might be one I'll pick up on an individual basis, or Microsoft when it makes more sense in the future. But for now, I'll get that exposure through the S&P 500. But get ready for a wild week, because this week will be a huge determining factor to if the market was overbought. Do we even see a correction if earnings are good? How does the market, digest what's been going on in this tougher, higher interest rate environment that's been largely affecting the Canadian markets, right? The Canadian markets have been absolutely abysmal from a return standpoint, but I mentioned the Canadian markets, I think, is where you want to focus if you just need cash flow today and good cash flow growth. You're not going to get probably outsized returns past, what's been going on when we're cutting back now on immigration, especially I'm sure you've seen some of it with the students. The government's taking in like 30% less or half as much to students that are coming over to be educated. I think we're going to start seeing a lot of problems because it's unaffordable here for immigrants to come in. On top of that, the regulations on the banks that are taxing an extra 1.5 points on their corporate taxes over $500,000, plus they're doing a lot of stringent things that aren't necessarily bad, but are definitely going to hinder the bank's performance over the next 5 to 10 years. Now, obviously, there's no change on the interest rates. I don't think anybody was expecting a change to the up or downside. I don't expect any major interest rate cuts till probably summer or the latter half of this year, and then definitely into 2025, where we'll start seeing a lot of recovery in a lot of the stocks we love. And I'm really anticipating a lot from the bank earnings, because the only thing we need to hope for right now, and I think these are huge buying opportunities, and I want to start accumulating some of these bank investments before the end of February when they start posting earnings, because my concern with the Canadian banks is what's going to happen is they'll stop putting loan loss provisions aside. They'll have kind of equal weighted out their portfolios against some of the, the degrading loans and just what they need for capital requirements, and that'll start hitting the bottom line again. Because I mentioned just the stock right now is purely following the earnings per share, which can't be actualized because of loan loss provisions. This is my bull statement on the banks, and I think they're trading at discounted levels because this is a temporary thing. So I'm probably looking to just cost average into the Horizon Equal Weight Bank ETF just to get that broad exposure again, which, as many of you know, I sold because I really just wanted to get my hands on Google stock before earnings, well before earnings, because I thought they were undervalued, and that is proving prudent that I'm getting about a 10% discount as it looks today, about 8 to 10%, because again, Google's, it was trading at a more 26 to 25 PE level when I was initially buying it, and when all these other stocks are skyrocketing, I think it was just under recognized. So we'll see where Google trades at from here, but I do want to get the banks back, and we have some exposure with my wife's portfolio to the banks already and things like TELUS, but I am Also looking at TELUS as somewhat of a recovery play, and it looks like we're going to say goodbye to these record crazy yields that we had back in October of last year, but they're still very discounted. And I think in the next 1 to 3 years, we'll start seeing a much healthier recovery from where we sit. And I think, again, you'll get an outsized initial return with a much higher yield if you're buying them today. But then as time goes beyond that, you'll see, I think, the growth start to slow from there. So the real opportunity only exists, in my opinion, right now to get outsized returns in a lot of these awesome Canadian, more foundational infrastructure-based companies. But obviously, these are just my opinions, and I'm very excited to see how this portfolio continues to evolve, as I feel like I'm still in a very early days of building this portfolio out, and it's just crazy the journey we've been on thus far and the gains we've seen, and kind of the rotation in and out through this insane, what would probably be the first crash many of us experienced during the pandemic. I mean, that was the first. I wasn't investing during the 2008 financial crisis, so I think it's really fun seeing how we kind of do this, the mistakes that I make, and how we can learn from all of this and some of the gains that we make along the way. But I'd love to know what you think and what you're buying in that comment section below.